Alright, welcome back. We are back after a couple of weeks of no videos, and pretty appropriate that the first video back for 2019 is the 10 must-watch charts for 2019. So this is actually comes from the 2018 end of year special edition. So I'm looking here at the article for this that I've posted on LinkedIn. I'll put the link into this in the comments and in the about section of this video, so you can go through and download that. So I'll show you. You can just go through to the website here, click the download link. I've put that report up as a one-off free download, so you might want to have a look at that. If you like this, if you like our charts, you'll definitely like that report. It's probably got about 50 charts in it. Some of like a lot of looking back at 2018 and you know, looking at what were some of the most interesting, useful, sort of popular charts, but also some of the best calls and the worst calls, bit of reflection. But then another part of that report was really important, and it was looking forward, because as fun as and amusing as it is sometimes to look back in time, as investors we get paid for looking forward and anticipating what might come. So here we go. We've got 10 charts here, going to go through each one of them. I think probably worth mentioning this at the start here, that the overall theme is one of transitions. I think this captures a lot of what's going on right now and some of the major moving parts. A bit of a transition for central banks from suppressors of volatility to sources of volatility, rotation across assets and markets, and a transition stage in the business market cycle as well. And as noted here, risk is clearly elevated, but as the charts show, so too is opportunity. And with that, particularly on the risk side, we'll start off with number one, which is deflation risk. So this chart here is what I call the deflatometer, and that's the percentage or proportion of countries we monitor, and it's basically however many countries we've got the data available for. So for equities, I think there's about 70 countries there. For industrial production, it might be about 100. Forward earnings is more around 47, because it comes down to data quality. But anyway, point about this chart is that as I was writing this report, over 80% of the world's equity markets were down year on year. And the worrying part about this chart is that you did have this spike in that red line, this the proportion of equity markets down year on year. You had that spike before industrial production and forward earnings collapsed, leading into 2008, 2009. So that's the worry. The worry is that this is basically, well, another way to think about it is that the red line there at the moment is pricing in a global recession. It's pricing in the possibility that industrial production and forward earnings also follow that line up, so that you also have most countries seeing contracting earnings, contracting levels of economic activity. That's not my base case, and as a matter of fact, if you look across some of the high frequency data, it's actually not that bad. We've definitely seen some softening, particularly so in the confidence indicators, and we'll get onto that in a second. But my base case is that this is markets that just are a little bit too panicked, but also a bit of a reset, and we'll also talk about that reset in a minute as well. So I think it's probably best to say this is a very interesting chart and move on to the next one. Manufacturing PMI. So this is a measure of confidence, really, a measure of confidence of the manufacturers. Basically, it's a survey, and they fill it in, and there's a bunch of different questions that they answer. Basically, if it's above the 50-point line, then these economies are in expansion. If it's below, it's in contraction. And you can see there that there's been a big moderation in developed economies, big loss of momentum there. And I think that there's definitely some real aspect to that, but then we've got to remember that it's people that are filling in these surveys, and they're just as liable to be affected by news headlines, market volatility, and on that front there's been plenty to knock economic confidence back, and I think that it's important to not get too carried away on this before we've got more sort of concrete evidence of economic slowdown or collapse. But the other interesting part of this chart is the black line. It's been relatively resilient. It's actually improved in the last couple of months, and we do get the next round of data for this week, so will be interesting to see whether EM can actually hang in there, if not get stronger, which I think there is a possibility that we actually see that. And speaking of EM versus DM, it's time to look at emerging versus developed market equities. So this line is the relative performance of the MSCI EM versus the MSCI World, or sometimes we like to call it MSCI. Now, when this line's going up, it means that EM is outperforming versus DM. Now, we're not talking about absolute performance here, we're talking about relative performance. So you can technically get a period where EM outperforms DM, but both markets actually fell. But most of the time when EM is outperforming, it's also encountering positive absolute returns as well, or probably most likely solid absolute returns. But anyway, the point of this chart is that after basically a relative bear market, or bear market in relative terms for EM over the last looks like 5 years, pretty significant bear market there, looks to be putting in the same kind of sort of multi-year double bottom pattern that we also saw around the turn of the millennia. And aside from that sort of emergent economic divergence that we're seeing there, where DM is slowing down and EM seems to be stabilizing, the other thing that would support that is relative valuations, but also absolute valuations. EM equities are looking particularly cheap at the moment, and that's been definitely helped by the correction that they went through. They took their medicine first. They took their medicine earlier in 2018 and had pretty tough time, both the equities and the currencies. So the good thing about that is that it creates the opportunity here. So I think that the stars are sort of slowly falling into place for emerging market equities here. And actually on the technicals, just put out the Global Cross Asset Market Monitor before, and there's some pretty interesting things going on the technical side for EM equities as well. And again with EM, but this one's more of a global chart as well. So the red line here is has been bolded and sort of made to stand out because that's the one that I thought was most interesting on this chart. But it's important to look at the other lines on there too, because they're really quite interesting as well. But the point there with the EM line is that if you look around late 2017, early 2018, EM was actually the first one to roll over. And then subsequently the other major regions, so Japan was next, and then probably UK was next, followed by, or say Europe actually followed by UK, and then finally US rolled over as well. And now we've actually got EM turning up first, which the other ones are starting to follow as well. So this is a pretty important distinction to make, because previously around there they global cyclicals versus defensives had gotten a little bit stretched, a little bit carried away, but this reset here has helped unwind some of that extreme, and it sort of sets the stage for cyclicals to possibly become a source of strength again, because they'd gone from a source of strength to a source of risk and possibly about to become a source of strength again. The other thing that's important about this is that if we were heading into some sort of global collapse or imminent slowdown, you'd expect to see cyclicals more persistently underperforming, and that's not what we're seeing. And since I put this article up, you know, the improvement that we've seen here has actually only improved even further. So this really is a key chart to have on your radar right now, and you know, particularly for the rest of the year, I believe. Number 5, and another bit of EM versus DM, but this is just highlighting some trends here in global central banks. So this is part of a set of charts that I have, sort of global monetary policy map. Let's explain what this chart means. So it's the percentage of central banks where their last rate move was an interest rate hike. So if it's at 100%, then basically all the central banks in that cohort either are hiking rates or were hiking rates. And if it's down at 0, it means that they're basically all in rate cutting mode. And you can see there that basically in 2017 there was, you know, rate hikers were definitely in the minority. And now going into 2019, rate hikers are actually in the majority, particularly EM. And I think that a big part of that is basically being dragged in that direction by the Fed, but also you know, 2017 we did see 2018 to a lesser extent, we saw pretty solid growth and inflation figures around the world, and so it's quite natural that you would have central banks you know, slowly moving away from emergency policy settings. The bad thing about this chart is that, you know, it very much is part of that theme where central banks go from suppressing volatility to actually being a source of volatility, which, you know, we've definitely seen that through much of last year. But I guess the other thing is that it's actually getting towards the high side now. So it would not be surprising at all to see a little bit of a pause. And actually, I was looking at the data before, and for January, so far for January, there's been no rate hikes or no rate cuts across any central bank. So there's still a few days left of January, but it could be a record-breaking month where there are no central bank actions. So that's you know, quite indicative of the kind of environment that we find ourselves in, a bit of a wait-and-see moment there. Now, also in the topic of central banks and interest rates is cash allocations. And the reason those two are linked is because, you know, higher interest rates are, the less opportunity cost is for holding cash. Now, this chart I found particularly interesting. It's one that I was, you know, really emphasizing last year because it had reached record lows or cycle lows, depending on which measure you look at. It's really just 3 different measures of the same thing, but just it's always good to get a few different metrics in just to confirm the signal there. And so, you know, basically there's not that much, there wasn't much dry powder left, and you know, to be fair, when cash rates were so low, it didn't make that much sense to hold cash. But now that cash rates are rising and valuations at least were expensive, you know, definitely it did make sense to have a bit more cash. But I think people are sort of catching on to this one a little bit late. Possibly going to see cash allocations head a little bit higher. This lurch up that we've seen actually is interesting note in passing there. The movement that we saw there, that big sort of raising of cash, if you look at the year-on-year change, that's actually been putting in a bit of a contrarian buying signal. So it's one to note, one to keep an eye on as well. And again, with rate hikes, looking at the Fed in particular for this one, you can see here that basically when you get a Fed rate hike cycle, you typically tend to see a blowout in credit spreads sooner or later. And there's a few good reasons for that. For one, rate hiking cycles tend to precipitate the end of an economic cycle, and when you have the end of an economic cycle, then you tend to have a higher probability of defaults and deterioration of credit quality, so it makes sense that credit spreads would widen. The other thing is that it tightens up financial conditions and also presents an alternative for credit investors, because if they were going out there to try and get income and then cash rates rise, well, it presents another way to actually get income without having to take on all that credit risk. And particularly, well, not so much now, but at least a few months ago, when credit spreads were so tight, you're basically not really being rewarded for taking on that credit risk. Now that credit spreads are sort of, well, still a little bit below average, it's probably less the case, but the thing is, we're not at the end of this cycle, and it's probably going to continue. I think that we will see a slower pace of rate hikes, and certainly if the trends that started unfolding towards the end of last year continue, then we'll probably see a pause. The other thing that we might see in the next few months is more and more talk about the balance sheet rundown, because that's an unusual factor that's that we haven't had before with this chart, or with many charts actually, is the running down of the Fed's balance sheet. It's definitely a lever they could pull to actually pause that program and actually continue reinvesting principal that's coming out from maturing bonds. So that's one to think about. That's a potential sort of bullet that they could use in their chamber. So that's one to think about. But basically, we're towards the end of the cycle here for credit. Possibly not quite there yet. Seeing a bunch of sort of orange lights, but not quite seeing the red lights yet for credit. Now, number 8 is global equity market valuations. This is something that I kind of alluded to earlier in this video. As I mentioned, there was a bit of a reset, as demonstrated in this red line here. Big reset there in terms of the global equity market correction. And part of that was actually correcting this overvaluation. So what this chart is showing you is the median forward PE ratio, and it's the Z-score of that across 47 countries. So it's showing you the median of that in the black line, and the upper quartile in the red line, lower quartile in the green line. So you can see there that the valuations were actually quite expensive around the start of 2018, and now at the start of 2019 they're actually a little bit on the cheap side. Not as cheap as they got in 2009 or in 2011, but certainly a big change versus this time last year. And for longer term investors, that basically puts the odds more into their favor. When you're buying when the market's expensive over the medium long term, you're putting the odds against yourself. When you're buying on the cheap side, you're putting the odds in your favor. So that's why, when I look at this chart and then I go back and look at that first chart and think, well, if they don't get the global recession that they're pricing in, then we're probably going to see a pretty good year for markets, possibly even a couple of good years, especially if EM starts to stabilize, and if it turns out that much of that was actually sentiment or just the noise factor, and we see cyclicals turn up, maybe see central banks go a little bit slower or pause, and see a little bit of that cash redeployed, then could be some interesting times ahead. Now, on the topic of emerging markets, commodities are actually in a very similar position. So they're cheap and out of favor. So it's not shown here, but I do have a sentiment indicator for emerging market equities, and that went basically into panic mode, which gives a contrarian bullish signal. And we're seeing similar thing for commodities. We've got here my valuation indicator and positioning indicator, both on the negative side. It's worth noting what's happened for commodities. This is the GSCI Light Energy Index. It's a little bit more diversified than the original GSCI index, which is a little bit more energy heavy. Basically, we're looking at diversified commodities here, which is an asset class that a lot of asset allocators have increasingly started to use, particularly after this period here. And when you have these times where both of them are down in the negatives, you generally get better results sort of a few years out if you're buying at those times versus if you're buying when they're both on the upside. Comes back to that valuation aspect that I talked about there. And again, if the global economy can avoid recession, then commodities are going to have a really good time. If you think about commodities, they generally tend to do well later in the cycle, which is where we are now. And they tend to do well also when EM is doing well, which I've already laid out the case there. So it's definitely one to be having on your radar and thinking pretty hard about. Now, last but not least is China. Now, last year when I went through this exercise, China was also number 10 because it was one of the most important charts. Last year it was the China stimulus chart. This time it's China A shares valuations. Now, one thing to note is that the black line there is China A shares excluding financials, because the thing is, when you look at China A shares, they look cheap a lot of the time because the banks trade at pretty low valuations, and part of that is just that there's low certainty around the quality of the bank's assets or the sustainability there. But then if you look at the ex-financials, then you can kind of get around that. The other thing that you can get around that with is that you just look at it versus history. I think that if you had that issue now, you probably had it in the past. So you can kind of still compare it against its own history. But anyway, look at that there. They're both on the low end. They're both pretty much at rock bottom. So China A shares, they're looking pretty cheap at the moment. And again, comes back to that commodities and emerging markets. Well, China is a big part of emerging markets, and they will become an increasingly big part of emerging markets as the MSCI steps up its inclusion over the coming years. But again, when you're coming from low valuations, it puts the odds in your favor. Could we go lower? Certainly. Could China face a financial crisis or an economic recession? It's definitely possible, but I think that the odds that we actually see something like that happen are pretty low, because they still have a vast tool set and they have the will and the way and the means to actually get in front of issues like that, because one benefit of having one party in a sort of autocratic authoritarian regime is that you can actually move and make decisions. You don't tend to have these China would probably never have a government shutdown the way that America did, because they if Xi Jinping has a decision to make, then he's going to make that decision and it's going to get implemented. And so the dynamics that are in play there, they they have that sort of social contract with the people that they have to pretty much keep the economy strong. Yes, they want to deliver. Yes, they want to transition to a more sustainable economy, but you can't really deliver or rebalance if your economy is crashing, and they're unlikely to let that happen. So I think that China, a lot of people are getting quite bearish on it, but I'm less bearish. I was a bit more bearish beginning of last year because at that stage, from a short-term, very practical macro perspective, it did pay to be bearish on China assets and China linked assets just from a tactical point of view. I tend to look at China from a bit more of a practical and tactical view than this big airy-fairy fluffy structural stuff that a lot of people try to look at and get carried away on the bearish front. But that's just me. I'm a practical person. So look, that's it. We'll end with that, and it's good. It's a good one to end on because it sort of ties you into with the commodities view there, global equities and emerging markets, and the general emerging market macro front there. And we'll leave it on this one because it's a very important one. And if you've got any questions, comments, put them in the YouTube video, or come over here, join me on LinkedIn, and we've already got a few comments here on this article. So, if you put your question there, I'll answer it back, and otherwise get in touch if you want to know more about what we're doing.